Can I see a emoji to show who is in the room this morning? It's morning where I am. You are welcome. You're welcome. And today I'm here as Crownstone Heights, Inspired to Profit. My name is Oluwatosin Olaleye, and it is such a joy to welcome you. Some people know me as Crystal, and that is fine. Some people just know me as Tosin. Whatever you know me as, it's a pleasure to have you here. This is the first of its kind in a while, and today we are welcoming you to the tax savings webinar. And as you know, we are in November, then it's December, Christmas, New Year, and next thing you know, everyone is screaming, it's time for taxes. And that's where we go, wah, wah. But what if we could help you to get ahead of the tax game? And what if there was still something you could do this year before the year runs out? Yes, I know it's the end of the year and we're all, winding down. But what if you could wind up on some things and that could save you in taxes? That's why we're here. Like I said, my name is Oluwatosin Olaleye. And in case I am not yet, I'll soon be your best friend, your best tax professional. And with me here today, I have Adewale Peter, who happens to be my partner in business and in life. And we are going to be bringing all of this to you. Together, we have over 25 years experience in the banking industry, in the banking and financial industry. And this is what we're bringing to bear here, not just in the United States, but spanning different continents. So we're taking all of this experience together and bringing it to you to help you understand your finances. Because the better you understand your finances, the more money you can keep. So we'll go right into it. Let's see, where are you joining us from? Can you share with us in the chat? Where are you joining us from? Let's see, where are you joining us from? I want to see some engagement in the chat. I see Northern Virginia. Shemina, you're welcome. Melinda is joining from Maryland. You are welcome. Evita is joining from Baltimore. Welcome, welcome. Dr. Michelle, it's good to see you. Columbia, Maryland. Amy is Northern VA. Bolanle Koyejo is it Koyejo or Koyejo? Bowie, Maryland. And Ronisa is joining from Georgia. You're welcome. You're welcome. And if you know that this is going to be of value to someone you know, why don't you just take the link and share with someone you know? There's still time for us to join the room. And I can see someone supporting me from Nigeria. Nigeria, they carry last. You're welcome, Samson. You are welcome. So we'll dive right into it because I don't want to take longer of your time. I know today is Saturday and we have a lot going on. So to honor your time and mine, we're going to go right into it and I'm going to be sharing my screen.
I think let me have the opportunity to just say
I apologize.
A beautiful welcome to all our guests that have took their time to join us. We really appreciate and we hope that you're going to receive value and that you can actually use to reserve so much money in your pocket this next tax season.
So can I confirm that you can see my screen first of all?
Yes, I can see your screen.
Okay, thank you. And thank you, Adewale. That is my partner in life, my husband of almost 17 years now. Sometimes I still can't believe I am able to stay in one place for that long, but God has been faithful. He is my supporter in so many things. And most of the things, time that you see me out there and I am showing up in the ways that I do show up, it's because I have this man. And yes, he's Mr. Consistent. So thank you, Adewale. I just want to honor you. I thought I would do this when you were taking over, but no better time than now. It's such a joy to have you here. And it's such a joy to have you beside me, going through life as we do together. So we're going to dive into it. I cannot see my notes. Let me try to share again. Just give me a moment because I need to see my notes. Let me see. All right, I'm going to stop sharing and share again. So while I'm doing this, can you let me know what are your expectations? One, So two questions. Number one, what are your expectations today? Number two, are you a business owner? Do you work W-2? Do you work 1099? What kind of taxes do you file usually? So if you're a business owner, you probably be filing, depending on the kind of business you have. It will either be 1120, 1065. So if you know the name of the tax form that you have, you can put it. So business owner, this is a tax form I file. But if you do not know, that's fine. Just let me know what the structure of your business is so that we can speak to the kind of business you have as well. But we're going to go all round. We're going to cover whether you're a W-2 or a 1099 or the different kinds of business. But so that when we want to pick examples, we'll be able to relate it to you. While we do that, I'll stop sharing and share again. Okay, I'm guessing my notes will not be visible. Okay, I'm doing this again. Give me a moment. Oh, Evita is W-2 and she says she's just here to learn. Evita, you're welcome. You are welcome to learn. And okay, I see what you can see now. For some reason, we are going to have to. Okay, I got it. And let's see, where is my chat? Chat. The way this thing be doing me sometimes. So Evita is the only one telling us what she does. Evita, thank you and you're welcome. So who else would like to share with us what's your what's your what's your business structure, or how do you earn? Do you earn on W-2? Do you earn on 1099? Is it a mix? Just so that we know what to speak to. Is it a mix of 1099 and W-2? Do you earn on, yeah, so Melinda said W-2 and 1099 and she's here to learn. Good to see you, Melinda. So I'm going to take it as we share it. In the meantime, what am I talking about today? I'm talking about the 1% tax mindset. You know, one thing about us is that we understand and we are taught to work hard, to go to school, to learn, so that we can earn money, so that we can always, and you know, one of the things we push in this country is to earn in six figures. We always want to earn in six figures. We feel like when we get there, then we have it made. And we have had it made. But the question is, of the six figures you're earning, how much are you taking home? And how much is really yours? Because we live in a country that we have to pay taxes. And so sometimes in the process of paying the taxes, the six figures sometimes becomes four figures if we are not careful, or five figures. So how do you keep more of what you earn? That's what we're here to discuss today. And the 1% tax mindset is that 1% of people that live in this country and pay minimum taxes. Fortunately for them, they are the highest in earners, but then they pay the lowest in taxes, and they have tax secrets. Those are the secrets we're sharing today. How the wealthy use the tax code to win, and how you can do the same. That's what we're talking about today. So there you go. And I can see only Elvita and Melinda that have shared with us how they earn. Can you please share with us how you earn? And if you're just joining us, please let us know where you're joining us from. I see a couple of people, Matilda, Olatunji. You're welcome. You're welcome. So, welcome. First of all, I would like to welcome you again to your tax transformation. And what are we learning today? Why the ultra wealthy pay less in taxes legally, and the fundamental mindset shifts that unlocks tax savings. Because whatever we teach you today, if there is no mindset shift, we are still going to remain exactly where we are. So for us to be able to move from where we are to where we need to be, there needs to be a mindset shift. Strategic structures and deductions that you can use immediately, not next year. Yes, we're recording. Thank you. Can we confirm that I'm recording? Adewale, please, are we recording? Because I can't see that screen.
Yes, we're recording, yeah.
Yes, thank you. So strategic structures and deductions that you can use immediately, not next year, not in April when they are filing your taxes. And I know some of us wait. I file taxes. I'm begging you. Please don't wait until April. If I'm filing your taxes, and if I'm not, whoever is filing your taxes, don't wait until April before you send all your documents in, so that there's enough room to get all the things we need to get done. But that's not why we are here today. We are trying to tell you that there are steps you can take right now that can help you to actually reduce that tax that you're going to pay in April. So strategic structures and deductions you can use immediately, and how to create a personalized tax plan that aligns with your goals. These are the things that we are going to be learning today. First of all, I want to bring you the subject of Tesla. How many of us know Tesla? If you know Tesla or you know Elon Musk, just you can raise your hand, you can, yeah. So I can see a thumbs up. Absolutely. Evita said yes. I see a thumbs up. So if you know Tesla, let me know. I see 2 thumbs up, even though I don't know. Okay, so Dr. Michelle and Bolanle know Tesla. What if I told you, Amy, thank you, Nina. Oh, good to see you, Nina. So Tesla is one of the highest earners in this country, and it is owned by no one other than Elon Musk, right? And we all know Elon Musk. If we did not know him before, from the time that this dispensation has been in power, we have known Elon Musk, right? Now, Elon Musk owns this corporation called Tesla, whose cars we drive, electronic vehicles. That corporation pays 0 federal taxes. And I'm giving you this example from the 2024 tax bill. Tesla paid 0 in federal taxes. Yeah, they paid 0. Yet they made a profit of $2.3 billion. How is it possible that someone made a profit of $2.3 billion and paid 0 in taxes? That's what we are here to learn. Their earnings between 2022 and 2024 is $10.8 billion. Billion, not million. B with a B. $10.8 billion. And yet, during that time, they paid only 0.4% of that amount in taxes. You wonder, isn't this unfair? Like, how much am I making? And yet, they are taxing me at the going rate is usually 23%, and I'm being taxed at 23%. And here is this man that is earning all the money in the United States and is being taxed nothing. Why is this happening? He didn't cheat the system. And there are so many Teslas out there. There are so many Elon Musk out there. Even our very own president is one of them. They didn't cheat the system. They understood it and they used it strategically. And these same tools are available for you. You know, the tools that made Elon Musk pay 0%, they are in the tax code. They are in the tax code. The question is, do you understand the tax code? Are you working with the tax code? Or is the tax code working against you? That's the question. Because the US tax code contains approximately 6,000 pages. 6,000 pages. Yet, out of 6,000 pages, only 30 pages teach you about how to collect taxes. Oh, you have to file your 1065, you have to file your 1045, whatever the 10, whatever it is, 1120, this is how you file it. Only 30 pages talk about this. The remaining 5,970 pages, they are instructions on how to keep your money. So why are we not winning at this game? If the IRS code is teaching us how to win at it, the remaining thousands of pages are filled with incentives, instructions, and legal strategies. Legal, emphasis on legal strategies for reducing your tax burden. The tax code isn't designed to take everything from you. It is designed to reward specific behaviors in the economy. So what the United States is doing is that they use the IRS as a moral suasion to persuade us to do what they would like to get done. And the more you do what they would like to get done, the more you are rewarded. So the IRS is a reward system. But what do they reward? How do you understand it? Hello? That's why you are here. And you have to give yourself a pat on the back and congratulate yourself that you have the opportunity to learn about it today. So let's talk about your mindset first. We have to have a mindset shift. I've been saying that. But what are you shifting from? Number one, most people think, and if this was you, please put a yes or a 1 in the chat. Do you think that taxes shrink your wealth? If you think that taxes reduce your wealth, say yes. I see Melinda. Do you think, awesome, awesome. Please, I need engagement so that I know that I'm talking to humans and not bots. Thank you. Do you think that the IRS takes from you and that your relationship is that of an adversary? Like all they want is just to take. And they are focused on minimizing contacts. Now say 1 so that we know that it's a separate answer. Yeah, I can see that Miss Melinda's second answer. Okay, Evita said, especially as a student. Number 3 question. So 3, then answer. Do you believe that you have to figure it out at the year end? Like, between February and March, that's when we start figuring it out. What do we do? How do we leverage? How do we reduce taxes this year? How many children do I have left that I can get the child credit for? Exactly. Amy says it's too late at that time. Thank you, Amy. Who else is giving me an answer for number 3? A last-minute scramble when options are limited and the opportunities have passed. Evita says she procrastinates a lot because it makes her anxious. I can understand Evita. Melinda said it's the reality that that's what we do. Nina said it's too late. Last minute is not good. Yet that's what we do every year, isn't it? We know that we know in our minds that the last minute, I call it lastminute.com, and the fire brigade approach. We know that approach is not good, but that's where we find ourselves eventually because you keep looking for information, but you really don't get it. So at the end of the day, you're just like, you know what, let's just go the way we went last year. How much more can I get in mileage? Last minute. Number 4 question, do you believe that taxes are mandatory? And that you have to passively accept whatever tax bill is given to you? There's nothing we can do about it. Nothing is as sure as debts and taxes after all. I see the yeses. So what if I told you that for the number 1 questions, taxes do not need to shrink your wealth? They can be your biggest wealth strategy, but it takes planning. And it takes planning that you make, not at the end of the year, but that you make all year long. In fact, what we are doing right now is Fire Brigade approach. It's something that you're going to do only once, I'm hoping, and then you go into tax planning. So when you proactively plan your taxes, it can transform your tax obligations to wealth building opportunities. And you know that number 2 question that says IRS is always taking from you? Plan before you earn. When you plan before you earn, when you think of whatever income is coming in and how you're going to pay the taxes on that, it helps you to strategically structure that income while anticipating the tax implications. Because most of the time, when we go sit down and we're getting a job and they say, how much do you want to earn? And so I want to earn 6 figures. You don't think about how you're going to use that, how you're going to pay your taxes on that. So you have to plan before you earn. How much of my income should come from W2? How much of my income should go to my business? If you have a business, different things you have to plan before you earn. I know a lot of people that they tell me, oh, I trade stocks. And then when I tell them that trading stocks means that they have to pay capital gains, and I have to charge them to put it on their tax return, they start frowning. But I didn't make so much money. IRS does not believe in that. As long as you earn over $10, you're going to pay taxes. So you had better plan for those taxes. Whatever investments you're getting into, plan for how you're going to pay taxes on it. What are the tax implications? And then the 3rd question, figure it out at the year end. There are incentives you can use year round proactively. And then the awareness of those tax incentives, because you have planned, you planned on that income. The awareness of those tax incentives, of those credits and deductions can then help you to plan your taxes and reduce your tax burden. And the last question is, taxes are mandatory, but you can control how you pay. You can control how you pay. Strategically timing your income and the method of selection to optimize your tax outcomes. And you do all of this within legal frameworks. And I know all of this is like, there's a lot for me to learn. Yes, there is. But guess what? Your favorite financial professional is right beside you. And we are going to be doing this together. So I'm going to be talking right now about a tax accountant versus a tax professional. How many of us have a tax accountant or have ever used a tax accountant? We call them CPAs. So don't let me use my English to scatter your own. We call them CPAs. So how many of us believe that CPAs are the way to go when you want to go file your taxes? Maybe you're not using them yet, but that is where you're deciding to go. First of all, let me burst your bubble. I'm not a CPA. Maybe some way, somehow I might, but I'm not really in a hurry to become one. I'm not a CPA because a CPA is compliance focused. Oh, Amy said she has used one before and they are not very helpful. Let me tell you what it looks like when you have a meeting with a CPA to file your taxes. They'll say, can I have all your documentation? And you give them to them. And then you say, they'll tell you, okay, so this is your tax burden. And you're like, that is too much. And they'll ask you only 2 questions. Like they have no ability to ask anything else. Only 2 questions. So what can we do for you? Do you want to maximize your 401k? Or do you want to give some money out? That's the only 2 options they have for you because they are wired to keep money for the United States government. So understanding the difference between compliance and strategy is the first step towards transforming your tax situation. A CPA, a tax accountant, is focused on compliance. A tax professional is focused on where do we have wiggle room in the tax strategies that we can use for you. So a CPA is focused, a tax accountant is focused on tax filing and making sure it's well filed. Meanwhile, a tax professional, which is what I am, is focused on planning your taxes. A CPA looks backwards, like, okay, give me everything that you worked through for 2025. You're going to give it to me in 2026, January through April. So they work retrospectively and they file your returns based on that historical data. And their primary goal is to remain as accurate as possible in reporting your finances of what already happened in the previous year. But a tax professional will interpret and leverage the tax code proactively throughout the year. So we help you create additional tax savings opportunities in real time to help you optimize your financial situation before you file your taxes. So that's the difference between a CPA, a tax accountant, and a tax professional. So let me see in the comments, which would you rather have in your corner? And while you're writing that, think of it this way. It is one that documents your financial past. They document your financial past. The other architects your financial future. But both are essential. I'm not saying a CPA is not good. They help you to keep your records and you need good record keeping. They help you to keep your records, but they can't help you to minimize the taxes you pay. Both are essential, but strategy always comes before compliance for maximum savings. Yes, so I am a tax consultant, I'm a tax professional. So thank you. And I'm going to be going on to talk about your strategic tax planning blueprints. My advice to you, my recommendation to you, my professional recommendation to you is that you have to get organized. You can't win in the tax game if you are not organized. Documentation has to be your friend. If you're an individual, we saw some people that talked about 1099s and W-2s. If that's all you file, then make sure that you gather your 1099, your W-2. If you own a property, your property statements, your property tax statements, and your medical bills. Because I tell you, those are the only kind of deductions you get. So you need to have all of that. If you had a serious medical situation that caused you to have a heavy medical bill, then we can get a deduction. If you have a property, we can get a deduction based on your property taxes. And the third thing, I'm not going to mention the children because we already know that we get, I think it's now down to, we get tax deductions on the kids if they are younger than 18, younger than 17 actually. If they are younger than 17, you get tax deductions. Once your kids are 17, that goes away. I have a 16-year-old, so don't ask me how market in that area. I'm not focusing on that because I know that eventually that is going away. So that can't be your tax plan that, oh, I'll get a return. Because the reason you don't get it, Amy, is because you probably are making too much money. So when you make too much money, the deductions become smaller. All of these things are automatic. Even there is the educational deduction. All of these are automatic. And if you earn beyond a certain point, then you don't get it. It's just that simple. But while you are on it, make sure that your documents, it's no longer 2,000 Ifeoluwa. From 2025, I think it's coming down to 1,600 or so. Adewale, can you help me?
No, it's been increased to 2,200.
2,200.
It's normally should be 1,000, but there was an increment that's supposed to expire this year. So when it expired, supposed to roll back to 1,000. Then the new administration increased it to 2,200, which I think is going to expire maybe in the next 2 years or 3 years, like that. So
absolutely,
yeah,
most of those deductions have an expiry date. For example, if you own solar in your home, you have been getting deductions. The deductions are going away. The deductions are going away. They are no longer there. So some of these deductions have time frames. And even the tax rates that we are paying now has a time frame. I think it ends in 2 years. Then it's going to go back up because it was negotiated. A lot of things that we do not know because we do not look into all of these tax laws. So if you're self-employed, this is my turn to talk to you. Ensure you have accurate bookkeeping. You have to document. Because your ability to get deductions is based on your ability to document what your activities are. Keep a diary of what you spend money on and why you spent it. If you went to Florida for a business convention, you have to write why you went to Florida, how many days you spent there. You have to be able to communicate that whatever deduction you have, because that's where the real game is, whatever deduction you have is reasonable. Yeah, it's reasonable and it is necessary for you to perform your business. So ensure you have accurate bookkeeping, but ensure you diarize. They are both very important. Accurate bookkeeping, your balance sheet and profit and loss statements. If you have staff or you are a single member LLC or you have an S corp, then you have to have your pay stubs and even your previous returns. And the rule of thumb is that you should have it for at least 3 years. Amy, they can't actually come back to audit you beyond 3 years. They audit you 3 years from the date you submitted that last tax return. So anything after 3 years, you're good. But for 3 years, you have to keep it. Then if it is any information about, yes, it's within 3 years after that. So let's say you submitted, your last submission was for your 2024 taxes was in 2026. That means they can still audit you for 2024 up until 2029. But the 3-year mark is what they use. So 3 years from when you file. That's the way it's calculated. So keep your previous returns. I always advise that you should have a folder on your desktop, and you can have it in your Google Drive as well, where all of these things are put according to the year, so that at any point in time you have access to it. Maybe a cloud drive, doesn't have to be Google. Document is very, very important. Number 2, know your tax liability. Forecast your income. And that is very easy to do. You can sit down. If you're sitting down with me, we're going to forecast your income. We'll take a look at what your income has been from January to October, and we will have a very good idea of what it will be for November and December, all things being equal. And then you can forecast your income and forecast your expenses. You cannot be talking expenses if you don't have a business. So this is for business owners. Forecast your expenses, and then we can project your year-end numbers and understand what your tax obligation is before it's too late to act. And in case you did not know, if you have not been filing your taxes every month, if you have to file taxes at the end of the year, you are going to pay a penalty for not filing it from January to December. So if you thought that you were going to get money back, for example, you are supposed to get a tax refund. So you say, you know what, don't take as much from my W-2, or I don't want to pay. Maybe you're a total business owner, so you don't have W-2 at all. And you say, don't take anything from me. If at the end of the year, you find out that you are in the green and you have to pay taxes, you pay a penalty for holding their money for 12 months. So I just wanted you to like take that and put it in the parking lot of wherever you're putting. And I hope we are taking notes. I do hope we're taking notes. So the third thing you have to do when you're creating your tax planning blueprint is to make sure that whosoever you're sitting down with to create your tax planning blueprints, make sure they understand what your goals are and that whatever they are creating for you aligns with your goals. It is very, very important. You have to define clear objectives. What are your goals? Do you want to max out your retirement accounts? Do you want to invest heavily in real estate industry, or do you want to start a business? Your tax strategy has to support your wealth building vision. They cannot work against each other. They have to work hand in hand. They have to be aligned. And then you have to get the help to create that tax plan. Build that strategic roadmap that will give you specific actions and what their impact will be on your adjusted gross income. We don't work with income, your regular income. It's your adjusted gross income, because your adjusted gross income is what you'll be taxed on. And IRS, when we put it in the system, which is what the CPAs do, or when I switch hats and I file your taxes, we put it in the system and it gives you what your adjusted gross income is. So if you're ready to take action, you have to know that that is the difference. The difference between the 99% and the 1% is not the access to the secrets. I can give you all the secrets, but it's the action you take, your willingness to actually take action and take that action proactively. So you take action and you execute strategically, and there is no other time to start than when? Today. That's when you start. So I'm going to be handing over to my partner, Adewale Olale, for the rest of it. I think this is a good place for me to hand over, isn't it?
Yeah, thank you so much, Krista, for this nuggets, this wonderful information that I can't keep on talking about tax planning. It's just being proactive. When you go to tax filing, you are kind of being reactive. When you wait till January, oh, you're going to meet your tax preparer. Oh, I have a document, I want to file taxes. You are being reactive because there's nothing much you can do at that time. But being tax planning is actually being proactive. And I'll keep on saying that how much money you hold, you're able to hold in your hand is as much as important and as how you earn the money. That's a very big one for me. Now, back to this slide. Now, I believe every one of us is familiar about this cash flow quadrant, Robert Kiyosaki, the cash flow. I believe it. If you know that, let me see yes on the chat comment on the chat. Okay. So we all know it, but for me, I want to take it from the point of taxes, right? On how you can actually look at it from tax perspective instead of just looking at it from the cash flow perspective. So now, from the left hand corner, right top corner, left hand, you see the employee. Everybody is trying to, we're employed. An employer, we pay about, depending on the state, depending on the brackets, we pay the federal taxes, we pay the state taxes. So in states where you pay taxes, so you'll be paying around 37% to 45%, depending on how much you earn and how much the state taxes are like. Now, you have limited write-offs, when it comes to being an employee, because it's actually the easiest lifestyle out of all the contract, out of all the small business, the big business, the investor. It is the easiest because you just go to work. How they make the money, whether the business owner make the money at the end of the day, it's not really much of your burden, but you collect your wages at the end of the month. So you have limited tax write-off, which is like if you have your own primary home, you pay the mortgage interest, you can write them off, the medicals, then the property taxes, or you want to give to charity, right? You can write that one off as well. And you can max out your 401k, you can pack money into your 401k to reduce your taxable liability or your taxable income. Now, going to the small businesses, the small businesses, they actually pay the highest taxes out of all the four quadrants. And I will explain, right? Now, most of the entities that we have, they're like pass-through entities. So when you talk about the S Corp, the LLC, the DBAs, they are all categorized as small businesses. And besides paying the income taxes, which is about 37 to 40% and all that, there's this taxes again that they pay, which is called self-employment taxes. It's a 15.3% taxes on all your income generated from, all the profit you make from being a small business, from being owning your LLC, from being a C Corp, from being an S Corp, and from having a DBA. Now, people will ask, okay, why did I have to have a small businesses if I'm paying this high amount of taxes? But the good thing about it is that the small businesses can write off so many expenses. They can turn around their daily income, daily expenditure to taxable write-offs for themselves. So all the, for example, right now they can have meals, they can eat and write it off. They can have home office and write it off, vehicle expenses, equipment, softwares, employee deductions. Again, all these things actually can reduce their taxable income. And let me tell you something, the goal is for us to have zero. That's actually the goal of tax planning. It is your interest or your income, or sorry, it's your profit that is being taxed. But by the time we have a zero, then there's nothing to pay so much taxes on. Now let's move to the big businesses, which is the corporation. The corporation, a lot of people time is at double taxation because you first pay your 21% corporate taxes, from all the profit you take. And when you take any distribution on it, for example, you are the owner of the corporation, after you pay the 21%, and any distribution or any income you receive, then you now pay your income taxes, federal and state on it, which can be as high as 37%, right? That is going to the taxes. So a lot of people are shying away from having a corporation because of all those double taxation. But talking to us in Crownstone Heights, there's a lot of ways all these things can be mitigated. There's a lot of strategies that can be implemented that can actually mitigate all these taxes and all that. So big businesses has a lot of write-offs. In fact, they have the highest numbers of write-offs and privileges and fringe benefits out of all these businesses that we have. Then going to the investors actually, they pay almost zero in taxes because they are actually putting their money in acquiring assets that helping the government in so many of the problems. For example, right now, you invested in real estate. Real estate, government cannot solve real estate problem. They are partnering with you, with the bank, to be able to solve real estate problems. So government is giving you a lot of incentives to be able to do that. So when you are investing in real estate, definitely you are time as an investor. You are investing in solar, you are investing in green energy, you are investing in data centers, you are investing in all these things that are actually solving even the employment problem of the government. So they actually give you a lot of incentives. So a lot of investors actually don't really pay, they pay zero in federal income taxes. Yeah, next slide, please. So okay. So the main thing right now is the advantage that you have as a business owner in the tax code. So there's this very, very important tax code, which is 162A, which is actually a code that IRS have put in place for all the business owners to be able to take advantage of the tax. And what it just states very simply, that as a business owner, as long you have the right to deduct any expenses that you feel that is ordinary, that you feel that is necessary and very reasonable in the pursuit of your income in your business, you can write it off. That is any expenses that is related, that you feel is reasonable, that is necessary and is ordinary to the business, then it can be written off as a tax deductible. So when you have a business, you are open to all this write-off. When you rent a house for your business, you can write it off. Any expenses you made at all, it is possible for you to write it off. And that is why I would categorically tell you today that being a W-2, fine, you are making a lot of money, you are earning a lot of money, but you cannot be able to save on taxes without having a business. Now, having a business doesn't mean that you need to resign, actually actively involved in that business, But there's a lot of investment that you can be done that can be translated as being having a business. You can be an investor, you can become a professional investor, right? To invest in real estate, you can invest in oil and gas, you can invest in movie, you can invest in stock, you can invest in so many things that can give you adequate tax write-up. And the good thing about it that, which I'm discussing in the next slide, that the way the government has structured the tax system of most of these businesses, they are taxed to has been as a pass-through entity, which means that the income or your losses that you recorded from your business can actually flow and reduce your W-2 taxable income. For example, right now, you have a loss of about 100,000 in your business, and you are earning, or your spouse or your is earning, that you are filing together is earning like 150,000 as a W-2 income. The loss there in your 100,000 can flow to reduce the W-2 income to now make it to be 50,000. So you are eligible to pay taxes on 50,000. That is the beauty of the Section 162A as applied to our business that we can, and that's what the rich people use to actually offset their tax liability. Next slide, please. So I'm going to go a little bit technical, with this structure. So I just want to describe how IRS or how United States see the structure to be, business structures to be. So there's what we call the LLC, which is limited liability company, and which is very, very known, is the most popular structure that exists today. So we have the legal structure part, and an entity can decide to have a tax structure as well. You can select the way you want to file taxes separately from the way it is legal structure-wise. For example, right now, when you have an LLC, the LLC can be a partnership, which I refer to as a multi-member. It can be a sole proprietorship, which I refer to as single-member LLC, and you can decide to choose to file your LLC as an S corporation, which is called S Corp. So invariably, S Corp is an LLC, but you decide to choose to file taxes as an S Corp. Now, a sole proprietorship means there's only one member that's opened the LLC. It is totally different in the terms of the way you file taxes, as having an LLC that is just owned by one person. It's totally different by the way you file taxes by LLC that is a partner that is belonging to two or more people. For example, right now in partnership, we use it Form 1065, if I'm correct. Then that is for partnership. But for sole proprietorship, it's just like a C Corp. So they tax you as if you are a DBA when you have a sole proprietor, when you have a single member LLC. And in terms of the legal structure as well, because in what we try to achieve in Crownstone Heights is the fact that when you're helping you to look at your business, we are looking at three things that we are trying to consider. Firstly, we are trying to consider how you can protect your assets. That is asset protection. So we help you to structure your business in such a way that you have adequate inside and outside liability being protected. And we help you to look at how you can effectively optimize your taxes as well. That's the second thing we look at. And the third thing we look at is how you can transfer your wealth to the next generation. So for us to be able to choose the right entity for you, we consider all those three things for us to be able to determine that. So going back to corporation right now, corporation, you can decide to file taxes as a C Corp or as S Corp. Mind you, I mentioned that S Corp is actually an LLC that is being chosen to file taxes as an S Corp. Corporation is the topmost level in all the entities that we have in the United States because it has a limited share number of holdings. It has the highest level of tax deduction that you can be applied to LLC. And this is just basically the way all the structures are being looked at in terms of the legal structure and in terms of the tax structure. The next slide, please.
You can control it from your end now.
Oh, okay. Just help me to do the next one. Okay.
No problem.
Okay. So, thank you. So, going for the tax strategy framework, as I've earlier mentioned, is the way we actually be able to structure for us to get the best tax advantage. Because what the tax code actually meant for, what the tax is meant for us to put money in our pockets. And I looked at tax as a game, just like a game of a football. You put your strategy in place, you want to determine how the results is going to look like. So you can determine the way your tax is going to be, even from the beginning of the year. For example, for me today, I actually have, and I know exactly how much I'm going to be taxed. I know how much I'm going to get for my tax return. So I can conveniently go to my employee because actually I have a business and I have a W-2 as well. So I can conveniently go to my employer and go and adjust my W-4 and tell them that, come, I don't want you to withhold my taxes because it's actually possible to tell the government that you don't want them to withhold your taxes. But mind you, you need to understand the fact that if you don't have a good strategy in place to be able to offset all those W-2 income, and at the end of the day, when you're filing your taxes, you are still going to pay. The government is going to charge you penalty on it. So for you to be able to do that, you need to really have a good strategy in place to be able to say, okay, I'm not going to pay. You are very sure that at the end of the year, your tax liability is going to be zero or it's going to be negative. Then you can go and edit or tell your employer that, oh, you don't want government to withhold your state and federal income taxes, what they withhold. So you can use that money to go and use it to invest in other assets that generate more income for you instead of giving the government the money to hold for you. And at the end of the year, they'll now return it back to you with no interest. So that's another way to look at it. So now, in looking at the tax strategy framework as a whole, we need to look at how do we need to establish our entity. And I've said it to you that when we are establishing an entity, we can sit down with you to help us to look, because everybody is unique. The time of what you want to look at in the short term and long term is unique to the kind of entity that you really want to establish. So we'll sit down with you to understand what your goal is like, right? So to determine the kind of entity based on the characteristics of each entity, the benefit, the demerits, and how you can actually optimize on tax. So we look at it and to give you the best entity to establish. And if there's a need to structure, to have multiple, because to me, it is very, very important for you not to leave money on the table. You need, in most cases, from my experience, you need to have more than one entity to be able to enhance the tax benefit. Most of these billionaires, most of these big companies, they have multiple entities. They have LLC, they have corporation, they have trust. They have so many entities for them to be able to enhance the benefit of this tax savings. Because if you have one entity, honestly, I can tell you, you are leaving so much money on the table. If it has even been proven that 93% of people that even have entity, they pay too much on taxes. So that is just first thing. Then the second way we need to look at, how do you want to reduce your taxes? What deductions are available to you? What kind of strategy can we put in place? Are we going to do Augusta rule? Are we going to go income shifting? Are you going to invest in movie that's some asset that there's some investment that actually can generate losses for you automatically? Like if you invest in oil and gas, for example, right now, you're going to get about 85% write-off from your taxes. So if you invest like $100,000 on oil and gas, for example, they're going to automatically, you're going to get 85,000 write-off to your taxes, and it's going to come in as like an active income. I will describe something. There's a difference between a passive and an active losses. Now, when you're involved in an active business, those active losses can reduce your W2 or other source of income. But when you are involved in passive income or passive losses, those passive losses cannot offset your other source of income. That's just different. So you need to look at, even when you are making investment, are you participating in an active capacity or in a passive capacity? So when you're investing in oil and gas, you don't need to be actively involved, but all your investment is known as active. When you're involved in real estate, when you're investing in real estate, there's a level of investment in real estate that will require material participation that will qualify you to be an active losses or active investment. If you can talk to us more deeper one-on-one on all those kind of investment that we can recommend for you to be able to get a lot of tax deductions or tax write-off to your W2 or your other source of income. So in that kind of scenario, there are a lot of strategy that can be put in place. Then going to the third quadrant, which is asset accumulation. There are a lot of places where you get your tax savings. Maybe, for example, you get a return of like 20,000. Where can you put this money for you to accumulate more money? Because it's not just going to be a free money. Fine, you're able to save money. So how do you want to invest the money? What kind of growth savings do you want to put the money? Do you want to put it in insurance? Do you want to put it in IUI? Do you want to put it in Roth IRA? You want to put it there? There's a lot of investment that can grow tax-free, because there's so many investment that when you invest it's still going to be paying capital gain on the profit on it. So all those things, we're going to look at it for you as well. Then the last one, which I mentioned, is the legacy planning. When you have a primary home, you want to pass it on to your beneficiary, to your children. How do you want to transfer it? Because the way you transfer it to, it matters a lot in the taxes that you're going to pay. Because there's a capital gain. Definitely, if you live in a house for like 2 years out of like 5 years, and you want to sell the house, definitely the first 250,000 is you're not going to pay any tax gain on it. However, if it's not in that scenario, you're going to pay capital gain on all the money. So when you move the money to your children, and it's not properly, the house or your asset is not properly placed in an entity that can protect the asset, your children is going to pay a huge amount of taxes, in that regard. Sorry, okay. So now let's go back to this year right now. We are in November 15, just about 6 weeks to go before 12/30/31. What can we still do, to reduce our tax liability? What can we still do today? Because now, as I've mentioned, tax planning is supposed to have started. If you really want to be proactive, you want to be intentional about your taxes, you need to start planning for your taxes from January of that year, not to wait till the end of the year before you start doing it. Come on. Oh, sorry.
Are you good?
Yeah, sorry, okay, I'm back. Sorry. So you don't need to wait till the end of the year before you start planning. So, but as it hits right now, what can we still do? Because we need to put some money in our pocket. So the first thing I've been able to come up, there's this rule that is called Augusta rule. Now, what does it mean? Augusta rule is a section in the tax code that says that when you have a multi-member LLC and you own your primary residence, that you can rent your primary residence to your LLC for 14 days in a year, tax-free. Please, if you understand what I said, just put yes in the comments. Or if you want me to explain more, it's a powerful tool but you need to have an LLC that is a multi-member for you to be able to take advantage of this strategy. Because the IRS knows that, you have a business, you can rent the entire building to your house. Maybe, for example, right now, you want to hold a training, you want to hold a retreat or a seminar in your house. It is something that is possible. So they give you the opportunity to rent the entire of your house. If it's like, maybe for example, in your area, you want to go to maybe an hotel to rent a floor or an event center or whatever, and that rate goes for like 3,000. So you just look at what is the best rate for your area where your house is located at, and you can rent it out to your business, and you take your money out. In fact, this can save you up to 40,000 to 50,000 of taxable income in a year if it's properly implemented. So that is one thing. This is still, we still have 6 weeks. Anyone that meets the requirement can still be able to implement this strategy to put some more money in your pocket. Then the second one that I would like to mention is to hire your children. Most people in America believe that, oh, I have a child. Oh, I'm going to get the 2,000, 2,500 tax credit, which is good. But this one is way more powerful, because as long as you have a child that is above 2 years, you can hire your child in your business and be able to pay your child a 15,750. I think it was 14,000 something last year, but it was just increased to 15,750 this year. Right? You can pay your child. So if you have 2 children, that means that's about 31,500 that you're able to deduct from your taxable income. And looking at, if, for example, right now you are taxed in the highest bracket, let's say you are in the 45% bracket, for example. So you're saving about almost 11,000 something from your tax just by hiring your children. So it's a more powerful tool to use, and we can still implement it this year. If you have an LLC and you have children, it's just something that you can talk to us, that we can still implement it this year to put money into your pocket. Then the next one I can talk about is the asset transfer. You have assets you are using for your business that you have not written up. Maybe you are having an asset on your name, and you have an LLC, or you have a business, or you have a corporation that you have not been able to depreciate. Because in the IRS code, the most important tools for a business owner to write off taxes is depreciation. That is the most powerful tools in the IRS code. So you have to look for a way, how can I depreciate assets? It's a powerful tool. So you have a car, for example, right now, you are using it to run a business. You have a personal car. Why can't you move the car to your business? And in doing that, you're able to write off all the expenses, all the gas of your business, and you're able to depreciate even the cost of buying the car as well. Now, there's another thing that the government introduced, which is called bonus depreciation. Some people refer to as acceleration depreciation. Now, before, what it means that any asset that has a lifetime of less than 20 years, you can actually depreciate it 100% in the first 1 year. Is a powerful. It used to be like the last year used to be like 80% that you can depreciate. You can write off in the first year, but with the big beautiful bill that's been increased back to 100%. So what it means that, you see a lot of people. I know a lot of people have heard this story of somebody buying a car that is more than 6,000 tons.
Please tell them the story of Grant Cardone.
I'm coming back. Yeah, I'll go to that. Somebody buying a car that weighs more than 6,000 pounds, because they want to. Those kind of car qualify for bonus depreciation. Now, when you have a car that is lower than that, you can still depreciate, but it can be depreciated over a period of 4 years. But when you have some kind of asset, 5 years. Sorry. So if you have some kind of asset, you can, like, if you have a rental property. In fact, I'm so marveled when I see people, they have property they are renting out, and they are renting on their name. Come on, that is a no. That is a disaster. It shouldn't be happening. Now I'll be hearing that they don't want, I don't want the government to know I'm rent. Oh, that is a disaster, because the government, in fact, there's what we call when you have a rental property or you are doing a short-term rent, there's what we call cost segregation study. It's a powerful bonus distribution that can make you to even create a loss of up to 200,000 in the first 1 year to your taxes. So even if you have only one rental property and you meet all the requirements, you can write off so much money, because you are helping government to save to housing problem. It's a very big tool. And definitely, I might not be able to explain to go deeper in that cost seg study on this platform. But if anybody is actually interested, you can actually reach out to us and we can actually take it one step at the other. But these are powerful tools that you can use. You can move your asset. Maybe you have bought a tool to use for your business. You can transfer it and you are running it on your personal name. You can transfer it to your business, which can still be done this year. So if anybody falls into that category, definitely you can reach out to us and we can help you to structure that for this year. And the last one, which is one of the most powerful tools being used by the billionaires, the Grant Cardone of this one. Oh, okay, you said I should mention the story of Grant Cardone. Okay.
Please, I love hearing that story.
So there's a year, I think about 3 years ago or thereabouts.
Yeah.
I know everybody
I
knows
think
Grant
it was
Cardone.
2020. It was during COVID.
If you know Grant Cardone, please, I want to see yes on the comment section. Grant Cardone is one of the biggest real estate investor in America. Is one of them. It's not, So there's this particular year he has about 100 million as in tax liability that's going to pay. He's going to pay taxes on 100 million profits for that year. And he's already getting to December 13th, just about some few days to the end of the year. So we're like, oh, why should I go and give this money to the IRS? That he can use the money to do something else. So the guy looked at it that he wants to buy an aircraft. That's December. And because he knows that when they purchase an aircraft that is being shown that it is used for business, it can accelerate the depreciation.
Be able to write it off. Yeah.
Yeah, it can accelerate, not even the write-off, but it can get accelerated depreciation on that asset. Because he knows that, he spoke to the CPA. The CPA said, oh, there's nothing I can do about it because, you have to pay that tax because you have made so much money.
No, actually, the CPA said the only way to go is either he pays or he gives out the money
to charity.
Or
you just go and buy something.
Money to do anything with. So he went to make inquiries by himself.
So by the time he knows that it's possible for him to do this, so he just ensured that he purchased that aircraft. When he called the aircraft company, they said, oh, we can't give you, there's no aircraft this year. We're sorry, it's not possible again. The kind of aircraft you have is just only meant for a very big organization, which we can't give to you. And Grant Cardone just say, okay, no problem. He called his accountant, wire $10 million to this company now. And the guy did it. And he was able to get the aircraft for $50 million. And by the time it comes to depreciation, he was able to write off all this $100 million out just because of that. He has an option. He can decide to carry the money and go and give to IRS, but decide to use the money to purchase an asset that he can use to depreciate and be able to use the money as to do another level of investment. And that's why it's powerful. Now, going to income shifting.
1 second, please. I also wanted to talk about the fact that when he got it, to be able to show that it is necessary and it is usable, it is reasonable, he got it around Christmas time. Every day until the end of the year, he was using that aircraft. Because remember, that was a strategy he was employing too close to the end of the year. So for him to be able to use it in that tax year, he had to take it up in the sky, starting from Christmas Day when he got delivery up until the end of the year. And he was just going for meetings. Even we don't know what they were discussing in the meeting, whether the meeting is real or not. He was going for meetings to make sure that he could prove the usability and the reasonability of the aircraft on his tax return. Please go ahead, sir.
Yeah, correct. So the last one, which is very powerful, is what we call income shifting. There's a couple of income shifting strategy available, but I'm just going to be discussing one here. And this one is moving, we call something OYCC, which is leveraging on your C Corp. What does it mean? I mentioned about C corporation and I mentioned about LLC. So this is a trick. I said tax is about game. You're playing the game. And you want to get a result. So the Arsenal or the striker you're going to put in, the defender you're going to put in to be able to get that result you want to get. So now you have, for example, now you have an LLC. Now there's a financial year end for all the entities in America. Your individual taxes, your LLC, your S Corp, your DBA, they all have the calendar year financial year end. That means the financial year runs from January to December. So everybody file taxes by January, for entity, you file your end is March 15th, and for individual is April 15th. However, for corporation, the financial year end is a fiscal year. That means you determine when your financial year will be when you have a corporation. So if you have a corporation set up in September, your financial year end will be September. So this leaves a very big gap, opportunity for investors, opportunity for business owner to be able to move income by having the right management and management agreement between their entities with their C corporation to provide management services or any kind of services, and you can use it to move money. This is legally acceptable, and this is what most of the top guys uses, especially even our president. They use this all this kind of because it is provided. So you have so much money in your S corp or your C or your LLC at December, and you don't know what, because you are asking as much as possible. You want to be liquid as well, because if you move in money to some of this investment, you are losing your liquidity as at that time, right? But you still want to be liquid, you still want to spend the money, but you don't want to go and give the IRS this money. You can offer services from your C Corp, can offer services to your LLC, and you pay the C Corp that money. So you move money from your LLC to your C Corp, right? Your LLC has about 200,000 profit as at that time, your tax liability as at that time, and you don't want to carry the money to LLC. You can create a management fee or a services which you have already been documented at the beginning of filing your tax of creating your entity. And that's why I said that it is very good. Even when you are creating your entity, we need to understand what your plan is, short term and long term. So if you have this entity structured available, you can shift money legally from one entity to another entity. So when you want to file your taxes for LLC, you move money because your corporation is providing services for your LLC. And when you want to do the other ones, you do this vice versa as well. And that's a very powerful tool reserved for the 1%, for the top 1% to use legally to be able to offset their taxable income. I believe you are getting some nugget out of all these things. So if you want any of this strategy to be applicable this year, please reach out to us and we're going to make it happen for you, right? So take control of your taxes today. Take control of your taxes today. What do you want to do? Do you want to keep on giving money to IRS, or do you want to save money and be able to determine the right cost of which you want to spend your money, or you want somebody to determine how you want to spend your money for you? The choice is yours, right? The choice is yours. Do you want to be able to leave a good legacy for your children's children by investing in asset protected liability, tax protected liability assets, that can generate wealth for your next generation? The choice is yours. Do you want to protect your assets? Do you want to ensure that you don't any lawsuit will not just wipe away all what you have worked for in your entire life? The choice is yours. Do you want to be able to have adequate protection for yourself, for all your assets, for your children. The choice is yours. If anyone is yes for you, definitely you can reach us. We are ready to serve you. We are ready to make this thing happen. This is what we are doing because we are living this life. What we are telling you right now is something that we have learned and we are living the life and we are seeing it working for us. And we want to share this information. We want people to become rich because in America today, if you want to be rich, you need to be able to do the right thing. If you're doing your W-2, you make a lot of money, but how much can you protect your money? How much can you protect yourself? Let me give you one bonus. So say, because time is going on, can I give you the bonus?
Just one more bonus.
Let me just give you one bonus. This is bonus that, it's, I know some people might be planning to go into that kind of business. When you have an operating entity, maybe you have an LLC is the one doing the business, and the operating entity is using some assets to generate the business or to be involved in the business. For example, you have a logistics business. You are doing a trucking business. You are using vehicles to execute your company, to generate income. And you have an LLC that's running that business. Please try as much as possible. In fact, don't try as much as possible. Make it very, very compulsory that company is not the one owning the asset you are using to generate the income. I'll repeat. Make it as a point of duty. In fact, it's very, very compulsory that when you have those things, create another company, which is like an holding company to hold your truck, the asset you are using to execute that business. Let another company hold those assets. And the company running the trucking business will now lease those assets from that other company. It is 101 asset protection. Asset protection 101. Don't make that mistake, please. And that's why I said that it is very important to have multiple entities across board, right? Because I'll tell you one scenario. If per adventure, that truck, maybe it runs to went to go and have an accident, involved in an accident and destroys some property, and there's a lawsuit. They're going to go after all the truck. You're going for them to claim the judgment, to reduce the damages. They're going to go after all the assets. But if it's not the trucking business that owns that asset, they cannot go after your truck. The only thing that will be affected is the business. And after the whole lawsuit is ended, you can open another business and let the business still rent the truck from another holding company, and the business continue. Thank you so much. Let me hand over the mic to
Thank you very, very much.
I believe you're able to get one thing, but I was trying to say, please, if you need any of those strategies to still be implemented this year, please reach out to us. We are ready to do it along with you.
It's not too late. Thank you. Thank you so much. You see why our 2 is chasing 10,000. That's why I love this man. Thank you so much. It's such a joy to have had you on the same platform with me. I don't take it for granted. So a couple of things I just want to highlight that we have both spoken about. When he talked about asset protection, you cannot build wealth without building protection. And I don't know if I'll be able to get him, and maybe we'll be doing a once a month class, maybe like a financial club of sorts, where we'll be sharing all of this, vital information. You can't have wealth that is not protected. So your wealth is in 3 ways. You're building it, you're protecting it. In fact, 4. So you're building it, you're protecting it, and then you're looking at how that's why we had that quadrant, how you're going to leave it behind and how you're going to make sure that it's increasing by not paying too much in taxes on it. It's very, very important. A lot of us are in the medical space, and we know that there are medical lawsuits all the time. And we also know we might have been privy to information about maybe a doctor or a nurse somewhere that got taken to court and everything they had ever worked for wiped out in a single moment. There are ways you can protect what you have worked for. It takes asking the right questions and asking the right people. So also, please, when we're talking about record keeping, make sure if you own a business, make sure when you get your receipts, you scan them. Why do I say scan them? And a lot of our accounting softwares will allow you to upload the receipts to this transaction. I say scan them because over time, these receipts wear and tear. The ink can run. Maybe it starts fading. And then 3 years down the line, IRS is asking for information and the receipts, you brought it out, but then there's nothing legible on it. So that's why it's very, 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 very important that you scan it when you come. So you come and if you have a bookkeeper, fantastic. If you don't, we could actually help you set up your bookkeeping. If you don't have a bookkeeper that works with you, you can work as your own bookkeeper.
I just gave you the slide, so
thank you. I didn't even know I did the slide. So maintain meticulous records. Maintain meticulous records and make sure it is, because the more something that is on a system is more believable than word of mouth. Do you know why? 3 years down the line, you're not going to remember what you did. And now the receipt has faded. Or maybe you even have the receipt, but how do you remember? So why did I go to, wait, I went to Bel Air. Why did I go to Bel Air? I can't remember. So that's why you have to also diarize. Take a moment, an hour a week to diarize what you have done and all the expenses you made. Why? What? Who was it with? It's very, very important. If possible, take pictures. Those are the things you use to prove yourself and retain your records properly. That's why I'm talking about the fact that you can have wear and tear on your receipts. Make sure that whatever you have diarized, you put it in a computer so that you always have it. Also, a word of caution, if you are a single member LLC or you are a sole proprietorship, most of the time, they are the ones that get audited the most. And I'll tell you why, because every other person has a different software from which they actually put together their income and their expenses, and then everything comes into their W-2 as one figure. But then with a sole proprietor or a single member LLC filing as a sole proprietor, they actually have to list all that income and expenses in there. And that is why IRS will now go at it with a torchlight. 33% of them get audited because IRS also knows that it is very easy to commingle funds. What's commingling funds? When you take your business card and you use it to make personal purchases, or you take your personal card and use it to make business purchases. What does that do? It lifts the veil of incorporation. What that means is that you can no longer separate yourself from your business. They say you are the same person. And when they say you are the same person, you cease to own a business. It's now you. And then you cannot get all those expenses that you were going to deduct before.
So let me just mention something. Something just clicked to me. Even when you talked about removing the veil of incorporation. So even for the single member LLC that you're not commingling fund, the IRS sees you as the same as the company, despite the fact that you are an LLC. They will tell you you have a liability protection, but because you file taxes as a sole proprietorship, they still see you. So if you peradventure have a legal suit or a litigation with a very experienced lawyer, they can prove the case that you, as a single member LLC, you are the same as your business. And there's nothing you can do. They will win the case. So that means your LLC is not LLC enough when you have a single member. And that is why, for us at Capstone, we advise that you should try as much as possible to have a multiple member LLC. With that, you can sleep and have your two eyes closed. Now this is a question that people used to ask us. Oh, I don't trust anybody. I don't have a spouse. I don't know who I can go into partnership with. That is a very big question that people used to ask us. We have a solution to that. You don't really need to form a partnership with anybody you don't trust if you don't want to do that. If you contact us, definitely there's a strategy we can use to ensure that your business is multi-member,
LLC.
it's turned to multiple member LLC without you going to meet somebody that you don't trust. So
Absolutely.
just reach out to us and we can make that one happen as well.
Absolutely. So paying taxes and scheduling your taxes, planning your taxes is mostly like maintaining your car. I know all of us, either we drive a car or we rode in one today. One way or the other, we have had a good relationship with cars. It helps us to get to where we're going faster. So imagine that you're driving your car and a whole year you didn't do an oil change. What is going to happen to that car? You didn't do an oil change in the whole of 1 year. Can anyone just tell us? Maybe the guys, or maybe a lady that is, very automotive inclined.
It'll break down.
It's gonna break down.
It'll break down.
The engine.
For sure. So it's the same thing. You have to regularly plan your taxes. Routine check-ins during the year. If you have a tax planner, what that means is that you're going to be meeting at least once a quarter to take a look at what you have so far and if we are going on the right plan. Do we need to bring in another strategy? So you need to get that oil change for yourself, for your business, for your family as the year goes along, at least once a quarter. Thank you. Ruth said the engine will knock. So this helps you to prevent expensive repairs, expensive tax liabilities later. And it also prevents major breakdowns. What about tire pressure? What if you never check your tire pressure? You just keep driving. You never check your tire pressure. Does anyone know what will happen? You end up with a flat. Absolutely. Or maybe worse, that tire could burst while you're on high speed. And that's another kettle of fish that we do not even want to go into. But what if you could check your tire pressure? I'm sorry?
I say, and the usage of your mileage, your gas too.
Yeah. It will so it affects. I didn't know that. See, we have an automotive junkie here now. Thank you. So it affects your mileage when you don't. So your tire affects your mileage. Wow. So you have to monitor your tire pressure. Now you have one more reason to monitor your tire pressure. Keep accurate records. It's the same thing as keeping accurate records. Track your deductions because you can't remember the last time you checked that tire pressure. You can't remember when you picked up that nail. The same way you can't remember the last time you went to that store. So who were your visitors? Who did you cook for? Do you have pictures? Do you have a breakdown of what you did that day? Now it's 2 years later and you're like, I'm sorry, I can't remember. So track your deductions. It prevents bigger problems later. What about you have that warning light on your dashboard, that annoying warning light, and it's there, and you've tried to clear it? Do you leave it or you try to clear it? Even when you go and it comes back, don't you keep going back to their mechanic and you'll be like, the light is still on, something is still wrong? I know I do. Because once that light comes on, for me, it's like anytime now, this car, anytime now, anytime now. And when the light never goes off, it's a sign for me that I'm done. I need to get a new car. Is anyone on that table with me? Like you keep repairing and the light keeps going on. That means the car needs a younger brother or sister. If you're on that table, please just raise your hand. It's the same thing as procrastination. You are procrastinating, and now it is December, and then it is January, and then we are on a scramble, and then it's another new year, and we gave IRS all of our money yet again. It happens every single year. You have the warning light. It's on now. Take action. Master the mundane. This is something this is why they say we accountants are very boring, because we deal with paper every day. But the reason we deal with papers every day is so that you would have a good night's sleep. Adopt new behaviors that will protect your corporate veil. Don't let them tear, that corporate veil to now separate the one that separates you from your business. Don't let it be taken out. Protect your corporate veil, ensure accurate records, and prevent penalties from the IRS. These habits are the foundation for sustainable tax savings. And if I filed your taxes last year, you would know that we found a couple of problems that a lot of people overlooked because I am not a tax filer. I'm a tax consultant. Now, the IRS rewards builders. If you are a builder, the IRS would not take money from you. They will reward you for it. So let's start businesses. Let's provide jobs. That's why the Elon Musks of this world are hitting it rich, because they are solving problems that the United States government, in all of its grace and its capacity, cannot solve. Because when you start businesses, then you provide jobs. You are going to grow to provide jobs. And when you provide jobs, why should they come and tax you for solving unemployment problems for them? When you invest in real estate, you are providing housing to people that they cannot house. Why would they want to charge you taxes? Why wouldn't they want to give you all it takes so that you can do better? And you are improving your communities. This is why they are rewarding you with a tax code, because you are actually helping to be a problem solver instead of being part of the problem. And anytime they see a W-2, I'm sorry? Someone spoke now. Anytime a W-2 earner is seen, guess what they say? They say you have free money, because you did not break a sweat to make that money. That's why they are the ones at the highest tax, they have the highest tax liability, because they didn't do anything. They just showed up at work. Someone else is carrying the pressure of whether that business will float for the next month or not. Someone else is carrying the pressure of all these things we talked about. But guess what? You and I just showed up at the job. So why should they give you any deductions? So for them to give you deductions, you have to have skin in the game.
Sorry, if you have questions, because actually we are trying to round up. If you have questions,
please put in your questions in the
chat. Then are we going to take maybe if you want to say, you can raise up your hand as well, so we can you can use the mic.
We've come to the end. Yeah. So that's it. And then I wanted to explain the depreciation. I saw that if he was asking. So depreciation is kind of when you say you can eat your cake and have it. So picture this: you have a car and you bought the car for $30,000. Right? And you're using the car reasonably and necessarily for your business. You can write off that car in 5 years. So what that means is that maybe you took a car note on that car for 5 years. So every month, let's say every year, it's 5 years, you're paying $6,000 for that car. That's already an expense, because you are paying back a loan you took to buy your car. So that is an expense already. Now, in addition to that, you can depreciate that car over 5 years. So in addition to paying $6,000 for the car as your car note in 1 year, you also get to take out $6,000 as depreciation for the same car. So instead of, and that's why you see that the rich, they buy things and they buy it with loans. At the end of the day, instead of just the $6,000, you are getting $12,000 in deductions in the same year. That's how depreciation works. So it's called eating your cake and having it. In English language, it's a way of making sure that when you're ready to buy the next car, you have enough money. You have set aside enough money. But hello, nobody stops you from going out again the next time you want to buy a car to go and buy the car again with a loan and take that money you had depreciated and put it to good use. Nobody says you can't do that. So Sherif said, how do you separate you from your business and your taxes? So the best way to do that is to create a business. And the business you create has to be well structured to make sure that you are separate from your business. Most of the time, a lot of us go online when we want to set up LLCs, and we just go online and we pay $200 and they give us an LLC and everybody says thank you and see you later. Guess what? That LLC you went to create online is not separating you enough from your business. For you to separate yourself from your business, some things have to be put in place in the, what do you call it?
Okay, so in your operating agreement, there's some provision that actually gives you both inside and outside liability. So if you have a generic operating agreement, it's not very solid. So there's some items, there's a provision that should be in your operating agreement that solidify your protection. That is one part. So even when you do a single member, but moving to a multiple member, gives you a lot of
Additional.
separation with the right operating agreement, so you can actually differentiate. In terms of taxes, you can separate from taxes, because from a single member, you cannot differentiate yourself from taxes. So the only way is to have, at least for the minimum, a multi-member LLC. An S corp as well separate you from business in terms of taxes, and a C corp to separate you from yourself and from taxes as well. And with the right operating agreement, you're able to get the both inside and outside liability protection for yourself.
Absolutely. Samson, I think we're going to set up that club, and we will share with you when we are ready. I think we're going to set up a community where we are going to be sharing how to start your business and what the steps you should take as you go along to make sure that you are well. And it's not going to be free. I'm sorry. For you to be a part of that community, it's not going to be free, but we'll be consistently, so you'll be able to move along with other business owners, take the first step, come back, okay, I've taken the first step. Because if I decide to go to launch on this now, it will take us another 1 hour. It will take us another 1 hour. And then there's still no follow through. So we need to make sure that there will be follow through. You take the first step, you come back when you have that, and then you take the next step and you keep going. So there'll be hand holding along the way. So thank you for your question. I think that will be the best way to answer it.
So Samson asks, please define what structures my LLC to structure
That's
my
what I just
LLC
answered.
properly. Okay, got you.
That's what I just answered. I said
Yeah.
we will not be able to finish explaining in 1 hour, but we can always take it next time.
Yeah, well, basically the LLC, we have the multi-member LLC, we have the single member LLC, and we have an LLC that you can choose to file as an S corp. That is from the LLC side. And from the corporation, you have the C corp, the Inc. For example, right now, if you look at my backdrop, you see Crownstone Heights Inc. So you can have, if you have COP or Inc., that's how what separates corporation, from the other entity.
So do we have any other questions? And if you do want to ask, you can raise your hand and we would point you out to ask your question. If we do not, I do have a book that I wrote, and I said it is for young adults. However, I'm going to tell you, if you have zero experience in financial matters, then that book is for you. And the link is in the comments. Get that book, and then after you've read it, gift it to your children. Read it, implement, and gift it to your children. It's called Money Smarts, Real World Money Skills for Teens and Young Adults. However, it is not only for teenagers. I said it's for teens because a lot of teenagers and young adults do not believe that they should take care of their finances. That's why I targeted them in that book. But the information there is valid for every single person. Miss Joy, it's good to have you. Please go ahead and ask your question. Oh, fantastic. How can a musician or an author open an LLC? So you see why we say that each person's goal is different. So the kind of business structure we'll propose will be different. So why we will be very particular about this is because for a musician or an author, it's very easy for you to just make one music and people keep downloading. So you made the expense only once. You only went into the production room and production cycle and all of those costs only once. But then that is something that every time we click it and we listen to it, you get paid. That is what is called passive income. So the best way to do it is to take your business and put in it something that is also active, that you are actively doing. So that way, for example, passive income is that I have courses that people can download, but active income will be that I consistently have classes that people pay for and I have to do in person. So what that means is that for you, whatever you wore when you were doing the musical video is part of your income. When you go to do your book signing and you lodge in an hotel, it's part of your income because you are actively promoting what you passively made. So we need to look at other things that you can do that will be active, that we can bring into that business, that will make it an active business. Because passive income is taxed higher than active income, and they are separated from deductions. So we will have to sit down to talk about that, Ms. Joy. I hope I answered your question. Thank you. Who else has a question? Because we are rounding off now. If we do have a question, we have our link to connect with us. If you want to get, yes, Mr. Sheriff, please go ahead and ask your question. You can unmute. You're still muted. You can unmute.
Okay. Yeah. Thanks for the wealth of information you've shared with us today. And I think it's a very great exposure. And we will start working, and we will definitely contact you to pull us along. My question is about you said something about opening a company with some people, and which I did a company early this year with a third party, and the company I have not used it till now, and I'm thinking of what are my tax liability, what am I supposed to do to protect myself?
So this company that you opened, what kind of structure does it have? Do you know?
It's a single, like LLC with a single ownership.
So, but you said you own it with one other person, right?
No.
Just you?
Yes.
With a third party, maybe company all this online company that
got you. Okay, so the best thing to do is for us to sit down with you. We'll have to map out, because single member LLC is not helping you, right?
Okay.
And from what I even understand, you cannot effectively convert from single member LLC. Am I right on that, Wale?
You can
that.
convert. You still need, you kind of refiling. That's just it.
Oh, you have to refile. Got you.
Yeah, it's kind of doing,
Okay.
but
you are muted, Wale.
So another thing I'd like to mention, for example, you said you have not done anything on
Yes.
LLC. So even, there's some states that you require to be paying some annual filing to be in good standing. So even if you're not doing anything with your LLC, you still need to be paying that money to be in good standing for some states. So, I know in Maryland, I think it's about $300.
I think the company was open in Delaware. I think I have to pay maybe $800 to be in good standing. Wow, that's what I do so far.
Okay, but however, even if you have not started, if you're planning to start a business, there's IRS give provision for startup expenses, because they know that when you want to start a business, there's a lot of expenses that you need to incur that can still be written off. So depending on when you're trying to start, maybe it's something that, you're not starting at all right now, you can leave it. But if you're planning to start and you're generating income, all the expenses that you're going to be generating to set up the business as well, even your filing fee, your phone call, everything can still be deducted from your business. But in terms of giving yourself a more tax benefits in line with what we have said, when you start getting so much things to be done, I think you should be looking at moving your business to looking at the structure long term and see how you can, when it's right time for you to move to a multi-member and be able to leverage on all those things. Because to me, even with a single member, there's so many tax write-off that you cannot get. Like the Augusta's rule, for example, you can't use that even if you have your own primary home. You can't still use it because you're a single member. You must be a multi-member before you can leverage on that tax strategy. Yeah.
Okay.
Thank you, Mr. Wulabi. So, Bolanle was asking about the club. So I said, if you want to join, please just text Business Builder, the word Business Builder. Text it to either the phone number the contacts or the email, and we'll reach out to you on the next steps. Just text or email, and that's fine. We'll take it from there. And with that, what that means is that you are interested in taking your financial future to the next level. You're getting ready to take advantage of necessary. I'm just going to mute you now because of the background noise. You're taking advantage of whatever leverage you have to be able to build better, protect better, and to hand it over to the next level. So it's not just about building your business, it's building everything. I always say that your business should be a family business. That's the way you have to see it, so that you understand that it's transgenerational. What you're building goes beyond you. If you don't see it as going beyond you, you would not know that it is worth it to make some sacrifices for that business. It goes beyond you. A lot of people have been taken to courts, and their houses, the very houses they live in, taken from them because they didn't know how to protect themselves. It's all part of building your business empire. And it's step by step. You don't build it when you have created it. You build it before the creation happens. So let's integrate building. Let's integrate protection. Let's integrate leverage, tax leverage as we build up. So on that note, if we do not have any other questions, I think this is a good place for us to pack our motto for today. To pack the...
So I have a parting point before we leave. So I just want to say that if you have an hobby or you have a business you are doing, maybe from your basement, or you have something that you're just thinking of, or you're just getting money, or you're doing it under the table. Let me just put it that way. I want to advise you in as much as possible, because you are dropping so much money, you are putting so much money on the table for others. You are doing yourself a lot of disharm by not going entity-wise with your product, with your business. So I will advise that you today look at how you can create an entity for your business, and at the least, even if you're not ready, at the least try to have a DBA, even if you don't know what to do. So instead of you just leaving the money, or you're just getting something and I just want to get the money by cash, and you're not ready, at the least have a DBA. Well, there's some write-off you can do with a DBA. Have a bank account to your business, right? Effective bookkeeping. It is very, very important. You cannot save, you cannot create wealth, you cannot save on taxes without bookkeeping, without keeping adequate record of your expenses, which is very key. And lastly, don't commingle funds. Those are the four things I would like to say. I would like to tell you, if you are just doing something under the basement, or you're selling clothes, you're selling insurance, you're selling life insurance, you're selling anything you're selling at all that's generating money for you, try to create an entity and run that business, and run that hobby or whatever through an entity, and create your business account, create a business name, do a bookkeeping. You can talk to us for a bookkeeping. You can set the bookkeeping for you as well. If you don't know how to do that, you can set your chart of account and all this kind of stuff for you. So I would advise that we do that as a matter of importance. Thank you so much.
Thank you. And as we part, I believe time is of essence. We only have 6 weeks. And for most of the things that we're talking about, it's going to take time. It will be important, very, very important, for you to reach out to us if you are interested in taking any of these steps, so that we can begin to leverage the time that we have. I believe that if we are able to, and I can see some of my clients, so maybe next time I'll ask them to come and give us like a recommendation, just to speak to us. It's very, very important that we begin to build and not just focus on earning. That's my parting word. Focus on building. When you build, it outlasts you. Don't focus on earning, focus on building. It's very, very important. Shamina said this is our official recommendation. So thank you very much for being here, for spending almost 2 hours. Wow, almost 2 hours of your Saturday with us. We do not take it lightly. God bless you and have a fantastic rest of your weekend. Jomi, my beloved son in Woman Well, please kindly play the song to end the room.
Your employee.
He's my employee. That's my number one
You
employee.
have